With all the uncertainty surrounding the housing market and the broader economy right now, people are rightfully a little nervous and have questions about whether or not right now is a good time to enter the housing market as an investor. And to me, this makes sense. Although I personally think that housing prices are going to go up for at least the next 3 to 6 months, I think right now there is probably more risk that prices are going to decline temporarily in the next 2 or 3 years than there has been in at least 10 years or really since the Great Recession. But does that mean that it is a bad time to invest in real estate? Well, not necessarily, because actually when you invest in rental properties, there are 4 ways that you generate returns, and only one of them depends on whether the market is up or down right now. So today I am going to go through these 4 ways that you generate returns in rental property investing and talk about why right now, given the larger macroeconomic picture, it still could be a good time to invest in real estate. What's going on, everyone? This is Dave Meyer, Vice President of Data and Analytics at BiggerPockets and the man behind the Instagram account, The Data Deli. And today I'm going to talk about some of the lesser talked about benefits of real estate investing that could be a boon for you during these uncertain economic times. But before we jump into that, please make sure to give us a thumbs up on this video and subscribe to the BiggerPockets YouTube channel. It is a really big help to us. With that, let's jump into the 4 ways that you generate returns using rental property investments. The first is appreciation. The second is cash flow, of course. And then we also have 2 lesser known benefits, which are loan paydown, also known as amortization, and tax benefits. Let's go through these one by one. And to do so, I'm going to go to our whiteboard and walk you through some of the data about each of these 4 ways of generating returns. All right, so the first thing that we're going to talk about is appreciation. And this is probably the most on everyone's mind right now, because this is the number 1 way of generating returns that is actually impacted by whether the market is going up or down. And appreciation, if you don't already know, is just when you buy an asset at one price and the price of that asset goes up over time. So for example, if you bought a home for $200,000 and a few years from now it's worth $250,000, you would say that your home has appreciated by $50,000. And hopefully you should be able to see that this is impacted by market cycles, because if you buy at $200,000 and then the price of your house goes down to $150,000, you have actually lost a bunch of money, and no one wants to do that. That is probably the main reason people are fearful of getting into real estate investing right now. And that makes sense. Listen, no one wants to buy at the height of the market only to see their asset go down. I want to show you some data about appreciation just so you fully understand what's going on here. The first point I want to make is, one, there are actually 2 ways of generating appreciation. One is market appreciation, which is basically what I've been talking about. You buy something and then hope that it goes up. Maybe you buy in a great area and that becomes in more demand, so your asset price goes up. The other is forced appreciation, where you actually add value to the property and therefore force the value of your property to go up. This is common in the Burr method. I'm not really talking about that forced appreciation today. What I'm talking about is market appreciation. And what I want to show here is 2 things. One is that regardless of when you buy, or at least in American history, regardless of when you buy, asset prices have always gone back up. So right here is the height of the post-Great Recession housing boom. And you can see that although things did really go down for quite a while, they did even back out. It took about 7 or 8 years for things to get back to normal. No one wants that, but they do eventually recover. And I also want to show that things did get really bad. Like you can see here that we had this red line here is year over year growth. So you can see that here in 2008, 2009, we saw 6% returns declines. Then we saw a bunch of years of negative growth in the housing market. And so this is really impacted by the market. You can actually lose money in real estate if you buy at the height of the market and you come down and you sell at this low area. Like if you sold here, you could have lost money. If you waited, you could have gained money. So if you are afraid to get into the housing market because of appreciation, my advice is if you're going to buy property, just make sure that you're going to hold on to it for at least 5 years. That's probably a safe way to think about investing right now for appreciation. But the point of this video is that even if your appreciation is negative or flat, you can actually generate a positive return based on the other 3 ways of generating returns from rental property investing. And the second thing is, regardless of the market is up or down, you can still generate cash flow. And I know there's probably people out there thinking, well, if the market crashes, cash flow is going to decline, right? Not exactly. If there's a really bad recession and a lot of people lose their money, that could happen. But let's look at what happened back in 2007 to see if cash flow really declined. This green line here is the median rent in the United States according to the US Census. And you can see that it did decline around here. You know, it peaked around 2008, bottomed out around here in 2012 or 2013, and then went back up. But if you look at this red line, you can see that it wasn't nearly as bad as what happened to the appreciation market. So you can see the worst year that we had here was not even a 2% decline in rent. And that means that if you had a good positive cash on cash return, a 2% decline in rent is probably not going to take you from a positive cash on cash return to a negative one. So you could still be generating cash flow. And of all of the metrics I'm talking about today, or all the ways of generating returns I'm talking about today, I think cash flow is the most important. Because if you invest and the market does decline, and no one really knows when that might happen, cash flow is the best way to insulate yourself from a negative outcome. Because if you have good cash flow, you can ride out these negative times, right? If you had good cash flow in 2007, you could have just waited till 2013. You're still generating a great income from your cash flow. You can wait it out until appreciation at least gets back to the level you bought it at, or hopefully you waited even longer and generated a solid return in terms of appreciation. The third way of generating returns in rental property investing is that one I think that might be the most overlooked of any of them. So I put a bunch of charts here, and this really has to do with the nature of a mortgage. And basically, when you own a rental property and you use leverage to buy it, when you use a loan to buy that rental property, someone else is paying off your loan for you in the form of rent. And so I put together a pretty simple scenario here where we bought a house for $375,000. You can see that right here. That's about the median home price in the US right now. It's crazy, but that's true. And I'm going to say that we put 25% down at about a 4% interest rate. Everything else is pretty standard. So what you can see on the right here in this chart is what's called an amortization schedule or an amortization chart. And you can see that over time, so you are paying down your principal, right? The principal is the amount of money that you owe back to the bank when you sell it, or at the end of 30 years. In this example, it's just done because you've paid it all back. But you can see that this gray line is how much principal you've paid. And so you can think of that as money that you no longer owe the bank. That is a form of profit. And you can see this down here. So in the first year, principal paid about $5,000. So your tenants are paying down $5,000 of a loan for you. You never have to pay that back again. Then it's $10,000, $15,000, $21,000. That really, really adds up over time. And if you go back to this chart, you can see that the slope of this curve actually gets steeper over time. We're not going to get into the nature of how loans work today, but just know that the longer you hold on to a loan, the more principal you are paying down every single month. So you get a better and better return there. Excuse me, you don't necessarily get a better return, but you pay down more actual cash each year. But what this all means, what this all actually means is I actually figured out what this turns out to be in terms of a compound annual growth rate, which I think is one of the best measures of ROI, a lot better than just regular ROI because it compounds. And you can see that in year one, your amortization, your loan pay down alone accounts for a 5% return. And by the end, it goes down to about a 4.6% return. If you can't see that, I'll write it here, 4.6% return. This is a 5% return. And this is a compound annual growth rate, CAGR. And this is important because to me, this really sets the floor for a real estate investment super high, right? Even if your cash flow is flat, if you're making $1 a month and your appreciation is down, you can still make a 5% return per year just by having someone pay off your loan for you. And this is a often overlooked benefit of rental property investing. And I think something that's super important, especially in an inflationary environment like we are today, because inflation right now is at 7%. So if you just keep your money in a checking account or even a savings account, you're going to lose about 7% of your spending power every single year. Whereas this shows you that even if your housing price stays flat and even if you are making no cash flow, you're at least earning 5% on your money, which will counteract most of inflation. So something you should really think about when you're thinking about how to mitigate inflation, how to navigate this really strange economy right now, is that amortization and loan paydown sets up a really good baseline return for you. Just for context, the S&P 500 typically returns about 8 or 9%. We're talking about 5% return here without cash flow or appreciation. The last way that you can generate returns using rental property investing is another overlooked one, which is tax benefits. And listen, I'm not a CPA. I don't know every single tax benefit, but I do want to show the most popular benefit for rental property investors, which is known as depreciation. And basically what this is the government says that the value, not the value, the utility of the property that you own is going to decline every year, right? The roof degrades, the foundation gets worse, you have to replace all this stuff, and they allow you to deduct a certain amount of that decreased utility of your home each year in the form of taxes. And the formula for doing that is you just take the property value as assessed by your local government, the assessed value of your property, and you divide it by 27.5. Some actuary somewhere decided that 27.5 is the magic number of years, and so you do that. So just as an example, your property value is $375,000. Again, that's the median home price in the US right now. So if you divide this by 27.5, should have written that out, you get $13,636. That's the amount that you get to write off. So let's just say, for example, that you were in a tax bracket where you pay about 30% income tax. That means that if you multiplied this number by 0.3, your 30%, that means you're paying $4,091, and I'm rounding here. That means that you will have saved on taxes $4,000 just by owning that property. So if you add that to the $4,000 or $5,000 you made in year one, you're making about $9,000 in this first year just from tax benefits and amortization. And I don't know off the top of my head what that would be in terms of CAGR, but I bet you, actually, I am positive, I don't know the exact number, that it will outpace inflation. So even though rental property investing seems risky because the market is going up and down right now, and there is always risk in investing, by combining all of these benefits of rental property investing, just amortization and tax benefits alone, you're probably going to earn a 7, 8, maybe 9% return on your money. And that is not coming into your bank account every month. But if you're investing for the long term, that money is compounding and growing for you. The same thing is true about cash flow. If you even added a 3 or 4% cash on cash return, now you're in double-digit returns independent of what the market does. As long as you don't sell at the bottom of the market, you can still be generating returns while you wait for the value of your assets to recover, which they will do. And I mean, sure, I don't know exactly when a crash might come. And again, I don't actually think it's going to be a crash. I would call it a correction. I think when prices do come down in the future, and they will, it will be single digits, maybe 5, 8%. And I think they'll probably bounce back to where previous highs in 2 or 3 years. So it's not going to be similar to what we saw in the Great Recession. And while you wait that out, you can still generate cash flow and you can still generate great returns from your tax benefits and your amortization. All right, that is all I got for you guys today. I'm Dave Meyer. If you have any feedback for me, any thoughts on this, please hit me up on Instagram at The Data Deli. If not, I'll see you all here next week.